shot, let's take a drive. Take a break from 9 to 5. It's so great to be alive. Oh yeah.
Wake up early, sun on the rise. 7 a.m. It's time to get wise. Money on the mind, we making a plan. Leveling up, yeah, we building the brand. Stocks going up, markets on the move. Now we're just power, that's the proof. Secure the bag, yeah, that's the way. Monday we build it, Friday we stay. Winning the game, learning the play. Secure the bag with Lakergurl every day. Secure the bag, don't miss the wave. Monday we build it, Friday we save. 7 a.m., come join the way. Secure the bag, yeah, get paid. Monday we build a bag, Friday we secure the bag. 7 a.m. PST, secure the bag with Lakergurl.
Good morning, and welcome to Secure the Bag with your host, of course, me, Stephanie Beard. Let me get this down, and I will get this up, okay? See where I can hide that. Okay, no. I'm going to get this right myself. Good morning. You guys bear with me. There we go. Good morning, everyone. Thank you for tuning in to Secure the Bag with me, of course, your host, Stephanie Beard, aka Lakergurl. This morning, wow, this market is doing something special, and it's going to be like this for a minute because of who's in charge of the world today. All right, you guys. Good morning again. It is Monday. It is March. Where are we at? March 16th. March 16th already. Wow. And we are already on episode 19. And we're going to be focusing this morning. It's going to be focusing on leverage in the market, borrowing to build your bag. So Monday, of course, we build the bag, and Friday we secure the bag. And this is where we talk about money, markets, and building financial power. And just remember, Monday is where we set the standard. And today we're talking about something very powerful, but also risky in the stock market. And again, like I said, that's leverage. And then if you don't know what leverage means in the stock market, in simple terms, it's using borrowed money to invest. And many professionals, many stock investors, professional investors use leverage. I don't do it. I just feel like it's too risky. But if you are that person who wants to do it, we're going to talk about it. But if you don't understand it, it can definitely also wipe your portfolio out. I know people who have done it and lost everything in their portfolio. So we're going to break it down this morning. But before I get into it, I got to get it into my disclaimer. This is not financial advice. Everything is for education purposes and entertainment purposes only. Please trade at your own risk tolerance. You want to trade at your own risk tolerance. I am not a financial advisor. I am a stock investor. I've been investing since 2018. So I know a little something. I've been successful. I've also lost money. So that's just what happens in the market. You're going to win sometimes, and you want to win most of the time. You want to win most of the time. So that's why I'm here to help you. Basically just tell you how I invest. So let's get into it. All right. Let me get my slides up here. There we go. All right. So what is leverage in the stock market? What is it? Some people don't, we're going to go ahead and break it down and tell you what it is. I forgot to put my phone on D&D. Hopefully no one calls me. But leverage means using borrowed money to increase the size of your investment. So instead of investing only the money you have, you want to borrow money to control a larger position. And for example, you invest $5,000 with leverage, you might control $10,000. So you're borrowing or more in stock. So if the stock rises, your profits increase faster. But if the stock falls, that's where your losses increase too. And that's why leverage must be used carefully. Now, margin trading. This is how you borrow, and this is where it comes in. This is where everything comes in, and this is where, oh boy, oh boy, oh boy. If you use margin trading, I'm a little tongue twisted this morning. I'm tired. I went out last night. Anyway, let's explain. Let's go ahead and break down um margin margin trading. Now, it's one of the most common ways investors borrow money to trade stocks. It's called margin trading. A margin account allows you to borrow money from your brokerage firm to buy more stocks than you can normally afford. In simple terms, your broker lends you money so you can control a larger position in the market. And Robinhood does margin margin trading. Webull does margin trading. Most of, and if not all platforms does margin trading. They let you borrow money. So, for example, let's say you deposit that $10,000 or $5,000, whichever you have, into your brokerage account. There is a minimum they give you. And with a margin account, the brokerage might allow you to borrow another 10,000. That means you can control $20,000 worth of stock. So that means you go in and you could buy Meta, you could buy Google, you could buy all these things, all these top end stocks that you know are strong companies. And if the stock price rises, your profits increase. Now, you do have to give them a little back for borrowing, but your profits increase because you're holding a larger position. But there's another side to this. If the stock falls, as I mentioned earlier, your losses increase, and that's where margin becomes very risky. And one of the biggest risks of margin trading is something called a margin call. Remember that. That's a margin call. It happens when the value of your investments drop too much. And if that happens, then that's when Robinhood or Webull, the brokerage that you're using, will require you to either deposit more money in your account or you will have to immediately sell your stocks. And if you don't act quickly, the broker can automatically sell your stock positions to recover the loan. And this can happen very fast during market drops. So if you don't do it quickly, they're going to go in and take their money. Now, the interest on borrowing the money, another thing investors, excuse me, often forget is that margin money is not free. It's just like borrowing from a bank. When you borrow from your broker, you pay interest on that loan. So if you borrow the $10,000 to buy stocks, you're paying interest while the investment is open. That means your investment has to outperform the interest rate just to break even. Let me repeat that. You're paying interest while the investment is open. That means your investment has to outperform the interest rate just to break even. So you got to pay them first. They're getting their money first. And then when some investors use margin, some experienced investors store in strong, they use margin to increase positions in strong companies. Like I said, the Nvidias, the Metas, the Googles, the Alphabet, which is the Alphabet. You buy those companies. If you're going to borrow, you want to make sure you put that money where you know, where you are 99% that this company is going to make a profit. And you buy, and when you use the margin, you want to buy during market pullbacks, not when it's in the green, but when it's in the red. And it's also, you got to think, this is when you're not thinking long term, you're thinking short term, because those trading opportunities are better because many long term investors prefer little or no margin because it's an increased risk. And the key lesson you want to take from this is margin can amplify gains, but it can also amplify losses. So the real question investors always ask themselves, is the potential reward worth adding the risk. And if you really have to be in the market for a while to know how the margin works, and you know that these stocks are going, and doing your homework behind these companies, learning how to read the charts and all those things to know that this stock is going to make a profit for you. Because the borrowing the money to invest requires, again, the words that I use here all the time is discipline and strategy. And one of the most common ways investors borrow money is to trade is through those margin accounts. So a margin account will allow you to borrow that money from your brokerage, and you won't have to worry about things. If you could, I'm like I said, I know people who have used the margin accounts and they lost every penny in their account, every penny. Okay, all right, let's get into borrowing against your stock portfolio, because there's also other ways of doing it. Now, there's another way. Sometimes investors borrow money in the stock market. Instead of selling their investments, they borrow against them. They will borrow against them like a secure loan. That's what it kind of seems like. And this is called securities-based lending. It allows investors to use their stocks as collateral for a loan. In simple terms, your investments become the asset that secures the money you borrow. So we're going to, for example, you own, say your portfolio is at $100,000 and you have $100,000 worth of stocks. A lender may allow you to borrow up to between 40 to 60% of that value. So you might be able to access $40,000 to $60,000 in cash without selling your investments. Now, why would investors do this? Why would you want to borrow against your portfolio? Well, because selling stocks can trigger capital gain taxes. And remember, if you're making a profit on your stocks, you're going to have to pay taxes on that profit. So this right here will allow you, when you're borrowing against it, it can trigger that. It won't trigger that. So then there's loss of future growth. Loss of future growth. So most people use the collateral and they borrow against because loss of future growth. And then there's the missed market opportunity. Some people don't, they get that FOMO, missed market opportunity. So borrowing allows you to keep their investments working. It allows you to keep your investment working when you borrow that. And some investors use security-based loans for business investments. If you are opening a small business or something of the kind, you can borrow against your portfolio to do so. Then there's real estate. If you want to buy a house or buy some type of land, real estate purchases come out of that. You can borrow against that. You're not losing your investment. And then you have short-term liquidity. That's also good. And then portfolio diversification. The ideal is to access capital while keeping long-term investments intact. Now, there is always a risk behind these things because just like margin, this strategy has risk. If the stock market drops and the value of your portfolio falls, the lender may require you to deposit additional funds. And then they also, just like using the margin accounts, you might have to even sell your investments or reduce the loan balance. So this is very similar to the margin call situation, but it's a little more, I think it's a little more easier to do. And it's not as risky, but the risk is always going to be there. So investors just need to borrow conservatively. You don't go in and borrow against your portfolio and get the maximum if you don't need it. So you borrowing against investments. When borrowing against your investments, it can provide that financial flexibility. But the key is always going to be discipline. It's always going to be that, because if markets move against you, then the leverage can turn into pressure. And the smartest investors always ask, can I still hold this position if the market drops? So that's why it's important. If you're going to do all of that, you best believe you bet to pick the companies that you know are going to make a bag for you. And that's how you protect that bag. Okay. Let's get into slide 4 there. All right. So next, we are going to be talking about using your credit. You can use credit or loans to invest in stocks. Okay, you can do that. This is another situation where investors like ourselves that when borrowing money outside the brokerage account to invest in the stock market, we like you know you use personal loans. You use your home. If you own a home, you can use home equity in your home. You can do even credit cards. Yes, credit cards. And the ideal is very simple: borrow money at one interest rate and invest it hoping to earn a higher return in the stock market. So, for example, let's say that you do take a $10,000 from personal loan at 7% interest. Okay, put that in your mindset. Then you take that investment, you take that money, and you invest it into the stocks, hoping that the market returns 10% or more. Now, if that investment performs well, that can make a big difference between the investment return and the loan interest. But then there also could be always a problem. Mm. And that means the stock market is not guaranteed. So if the market drops, because what goes up must come down, what goes down must come back up. But you're going to still owe on that loan. And this is why it's going to be risky, because unlike margin accounts that adjust automatically with the market, personal loans must be repaid on schedule. No matter what, they want their money. And that means you could end up with investment losses and monthly loan payments. And this can create pressure if the market goes through a downturn, which is right now, you guys. The market is in a downturn because of this war. And it's really affecting everything from, gas is high. The airlines prices are high. They're packed in there because they're of this partial shutdown. TSA employees are not getting paid. All this stuff is affecting the market. Everything like that affects the market. So when you just got to consider, when you want to borrow money to put into the stock market, you always got to make sure that the interest rates are low. And you also got to make sure that they have strong income stability. The stocks have that strong stability. And that if you're investing long term, then most financial professionals recommend extreme caution when you do it. And so basically, borrowing the money to invest can increase potential returns, but it also increase financial risk because markets can be unpredictable. And when borrowed money is involved, losses will hurt more. And I haven't lost my whole portfolio because I couldn't even imagine doing that. I would be crying for days. To lose your whole portfolio or half of it or even 10% of it based off of the move that you made from borrowing or using a margin account, it would be, very emotional for folks. So you got to take time. You got to know what you're doing before you do anything. Let's get into this next segment. Now, let's talk about the side of leverage that many investors don't fully understand. And that is when borrowing to invest becomes dangerous. Leverage can amplify profits, but it also amplifies the losses. And we do know that. I keep repeating these things because I want it embedded in your brain, because you got to know this if you are deciding that you want to use margin accounts or borrow money. So when you borrow the money that is involved, even small market drops can create big financial pressure. So let's imagine you as an investor has $10,000 of their own money. This is not house money that you made profit. This is your own money that you work hard for, and you invest it in giving them $20,000 in the market. If the market rises 10%, the investment grows to $22,000. That's a $2,000 gain, which looks great, right? But now let's flip the situation. If the market drops that 10%, the investment falls to $18,000. And then and you as the investor, you will still owe the borrowed $10,000, meaning the real equity drops significantly. And this is why leverage increases both reward and risk. And this is where you want to be in the market for some years, knowing what you doing before you try to borrow any money. But we got to talk about it. You got to know about it. Because based off of market volatility, stock markets do not move in straight lines. There are always periods of corrections, downturns, volatility. And if you as an investor borrow too aggressively, those market swings can force them to sell at the worst possible time, and that will create massive emotional pressure on you. Another risk is the psychological pressure. When investors use borrowed money, every market move feels larger. Instead of thinking long term, we may panic when prices fall. And this is where your emotional decision making can lead to poor investment choices. So just remember, leverage should never replace a strong investment strategy. Borrowing money should only be considered if you as an investor understands the risk and that you have a strategic long-term plan and that you can handle the potential losses. Because the goal is not just to build the wealth, the goal is to protect your bag while you're building it. All right. We're going to get into this last slide and then we're going to try to get into a play or look at the market because right now I'm looking at it, it tried to go up just a little. Gold and silver. I just wish silver would just do a big move. If it did that, it would make my life so much easier. But anyway, here are some smart ways and we as investors can use leverage. Basically, we've already talked about the risk of it all, of borrowing to invest. Now let's get into the smart ways that we can leverage it responsibly. Because leverage itself is not the problem. The real key is how you use it. As an experienced investor, you want to often use leverage strategically and cautiously, not aggressively. And that's where I think that the people that did lose their portfolio, half of it, they just moved too aggressively. They didn't know what they were doing too. So what you want to do is you want to rarely borrow the maximum amount available. Don't go to the tip top because it's looking good. Don't If they saying you could get $60,000, don't get it. Instead, you want to borrow well below the limit so you have wiggle room if the market drops. Because this will create a safety cushion for you. And the goal is to avoid being forced to sell your investments during market volatility. And then again, I mentioned it over and over today in this episode. Invest in strong companies. If I can't say it enough, please know what you're doing when you're investing, because leverage is used. And when we, as investors, we focus. You want to focus on stability. You want to focus on established companies rather than highly speculative trades. And these companies tend to have strong earnings. Apple, strong earnings. Nvidia, strong earnings. Meta, strong earnings. Google, strong earnings. These are for sure companies that are going to have long-term growth. And they also keep stable market positions. Unlike Tesla will drop real quick in one day, $30, $40. That's a lot of money. That's a lot of money to lose. So you don't want to do those type of companies, even though you feel that Tesla is a strong company, but it does have a lot of volatility behind it. So you don't want to do Tesla. And then you want to, or you can even do SPY, the ETF, the bundle of technology and healthcare, all those type of stocks in one basket. Those are also good to do as well. And when you invest, if you're going to do margin accounts or borrow money to get into the market, this will reduce your chance of large unexpected losses. So the next strategy is long-term investing. Leverage is sometimes used to plan to hold your positions for many years. But short-term trading with borrowed money can be extremely risky. Extremely risky. So you got to think long term investing, which allows time for the market to recover from temporary downturns. But again, you got to remember, if you choose in those companies and the money starts to if you know, go down and you borrow money, you got to pay them. They're going to take that. Your broker is going to expect you to have to pay them. So, and then you got to have some cash in reserve. Keep cash reserve available. This will allow you to handle situations like margin calls, market corrections, and unexpected expenses. Because if you keep that cash reserve, it will provide flexibility. And when the market moves unexpectedly. So, like I said, the news will affect the market. If anything like that's why I watch the squawk on the street, or I go into Yahoo Finance to make sure that whatever news is going to happen, you got to be prepared. So just remember, you guys, leverage can be powerful. It can be a powerful financial tool, but the smartest way to treat it is with discipline and respect, because the goal is not just to grow wealth quickly. The goal is to build the wealth sustainably. And that's how you truly build your bag. And that's how you truly secure your bag, you guys. I don't know if we're going to have time to get into a play. I want to go ahead. Let me try to go into real quick and see what the VIX. Remember what the VIX is? The VIX is the index that tells you what the market is doing. Is are investors putting money back into the market, or are they um, holding back because of what's going on in the world today? And when I looked at VIX over the weekend, you guys, it had went up. It went up to $27. The highest I've ever seen it was $30, which is not good. It's just not good. It's meaning that we as investors, we're holding back. We're not going to put our money back into the stock market until this volatility um cease. Right now, like I said, over the weekend it was high as $27. It is down. Please keep going down because it's at $23.76. It's okay. I mean, anything under $20 is best. 20 and under. That's when you know that investors are in confident and they're putting their money back into the market. And right now, it's you know, some investors are moving in slowly and they're saying, okay, let's move back in. Let's go ahead and put some money back into the market. Let's start buying some stocks. Let's start doing some option calls. So right now, it is down. It is down $3.43. I wanted to go all the way down. Ooh, if it could go down to $13 before Friday, I would be a happy camper. So that's what's going on with the VIX, the um which is the volatility index. All right, you guys, that went quick. Monday's always going quick for us. Let's get into we're going to go ahead and shut this down, you guys. I might go over just a because I wanted to check something else. But all right. Wow. Wow, wow, wow. Yeah. I'm hoping on silver. Silver is a little green right now. It's a little in the green right now. Just a little. But I needed to go back to where it was. And it's looking like gold is down a little. I'm not going to get into the five stocks that I always talk about. You guys could go look at them yourself. This will get you acclimated on how to go in and start checking these stocks and making sure that if it's a good time for you to enter the market. Um, I just want to say though, before ending the show, leverage is always going to be one of the most powerful tools in finance. But you always got to remember, power without knowledge becomes risk. So before borrowing to invest, make sure you understand both sides of the trade. And remember, Monday, we build that back, you guys. Friday, we're going to see you back here on Friday where we will secure the back. I am your host, Stephanie Beard, aka Laker Girl. And let me get my outro set up and ready for you guys. And yeah, thank you guys for tuning in. I really appreciate your support. Have a great day out there. If you're on the West Coast, stay cool. I understand on the East Coast, there's a lot of rain tornadoes are happening and all that. So be careful out there, you guys. Peace out. Have a great day. Okay, that's not the one I wanted. I want to play my music. So where is it? Hold on. Let me get into it. Here it is. I'm going to get this down pat.
Oh, you got it, girl.
Money moves, yeah, the market talks. Watch the charts while the clock still rocks. Knowledge first, yeah, that's the key. Building wealth for the family tree. Secure the bag, don't let it slip away. Secure the bag, learning every day. Monday we build it, stacking it right. Friday we lock it down tight. Groove line, money don't sleep, the market don't lag. That's why we tune in to secure the bag. 7 a.m. PST, Lakergurl bringing financial clarity. Stay smart, stay on your path. We'll see you next time. Secure the